let me take a moment to introduce our guest for today. So, today we have with us Mr. Amit Bivalkar, who is a founder of Sapient Wealth Advisors and Brokers Private Limited, which is a group of professional people from financial markets that have come together and established a highly successful company. As far as educational background is concerned, Amit sir had done his MBA from Pune University, and he had been National Merit Scholar in Economics during his graduation in Commerce. So he has over 23 plus years of financial services industry experience, and he had his stint with asset management companies of the likes of DPS ML, Fidelity, and AIG Group. He started Sapient Wealth Advisors in the year 2009, and today's Sapient Group manages assets over 12,000 crores with an SIP book of 40 crores per month. And Sapient has presence in Pune, Mumbai, Guwahati, and Kolkata with a team size of 130 people. So, a very warm welcome, sir. Just in case I missed out anything on your introduction, I would request you to add. And also, it would be interesting to know about how your journey started and how it has progressed over the years.
Thank you for the introduction. And I think 23 years of experience in the market actually only teaches you rather than you teaching anything to anyone. So, market has been kind, and over the years, it has been teaching us a lot of things which we should not do. And typically in personal finance, it is more about what you should not do rather than what you should do. So the market has been kind in teaching us that what mistakes one should avoid, and therefore what you can expect out of the market.
True, I totally second that. So, Amit sir, for today's session, we'll be keeping the session so as to clearing the myths around personal finance and knowing the intricacies. Having said that, there are people who believe that they do not need any financial plan and they are educated enough so as to manage their finances. And without a goal, without a direction, they end up doing mess which they realize at a later point in time. So I would request in the form of an opening note so as to briefly talk about today's topic. So from the topic we will take questions whichever comes to my mind as and when, and I also have a set of questions on my end, and then attendees are also free to send in their questions in the comments, or even they can send in a speaker request. So that way we will be able to just do justice to your time as well as the very important topic, which is personal finance. People take it lightly, but it is relevant to even seasoned investors who have spent considerable time in the market. So over to you, sir.
Yeah, thank you. I think this is the most important part of anybody's life, and personal finance actually is the management of an individual's financial resources to achieve financial goals and objectives. It actually involves making informed decisions, and I repeat, informed decisions about how to earn, how to save, how to invest, and how to spend money. Spending money is something which we all know because of the various apps and various aggregators. I think people know how to spend money, but people are also learning to savings and converting those savings into investments. Personal finance also can include, say, budgeting or saving for emergencies or paying off debt, or it can be simply investing for retirement or buying a home or purchasing an insurance and planning for the future. Whenever we talk of personal finance, why do we take it lightly? Because remember, we have come from a savings economy and we are going into a spending economy. We are trying to ape the West when it comes to spending. These guys have a 150-year lead in terms of savings and investment over us. But since we always jump ahead in India, Therefore, we are trying to ape them and trying to be a spending economy rather than an investing economy. The key components what one should actually look at in terms of personal finance. First and foremost thing is personal finance cannot happen without a person. So many people, as you rightly said, think that personal finance is something which they can manage. Surely they can manage, but the challenges which we are going to face in the coming years are going to be quite different. So you can't have a experience over yesteryears to actually make through the years which you are going to live in. Why I say that? Because the average age expectancy 20 years ago was maybe at 60, 65, which today has gone to 75, 80. And as science progresses, we might have an average individual who will probably live on till the age of 90. During this time, remember in your educational age till 24, 25, you are actually not earning anything. And if you stay on for till 90, you will have 30 years post your retirement where you are not going to earn anything. So, one important point, and I'm going to give some pointers here in between. One important thing which I have learned in my life is earning money is important, but generating money is also equally important. And how you generate money is what is going to see you through the 30 years of your post retirement. If you look at the components in a personal finance, they start with budgeting, they start with saving, investment, debt management, and risk management. Now, we have seen a lot of cards which gets issued as personal loan cards, and typically in the age group of 20 to 30, where you have your first job or where you are probably just into college, people tend to have aspirations without looking at what actually your income is. And therefore, when you try to look at this, you fall into the trap of debt at a very early age. Not to say this in a wrong way, but if you try to look at people who are into their 30s or 40s, I've seen a lot of clients also and their kids who actually come to me and say that they are in a credit card trap. This is more to do with because we had been taught earlier in our life that whatever you spend, you have to look at your income and then spend, do not take leverage. But what is happening now is that since everything is available on EMI, right from, I mean, I'll give you an example. There's a large NBFC company who has started giving your wedding garments on EMI now. And for that, you get a card and you pay those wedding garments over a period of 1 or 2 years. I mean, just imagine that you don't require a sherwani which is costing, say, 40,000 rupees. But since it is available on EMI, probably you will end up buying that and keep on paying that EMI for the next 2 to 3 years. Small mistakes can actually lead to very big consequences when it comes to personal finance. Budgeting, as I said, is the first step. But before going to budgeting, let me tell you point number two, which you can actually take down. What we always do, and we have been always taught, is income minus expenses is equal to savings. If we can just make one small change here and say income minus savings is equal to expenses. So you put aside a sum of money every month, irrespective of whatever you are earning. It can be as low as 500 rupees or 1000 rupees, but just instilling that discipline into everyone at an early age will actually give you a very comfortable retirement life. After you have set aside a particular amount every month, it involves budgeting, and budgeting means tracking income and expenses and creating a plan to allocate funds towards your specific financial goals. Now, as millennials, we have always heard this statement that we will live for the day and कल क्या होगा किसने देखा है. Saving actually involves setting aside money for emergencies, for short-term goals, and long-term goals, such as retirement and others, what I've spoken. Investing actually involves putting money into assets such as stocks, bonds, and real estate with the aim of generating returns over time. Now, one important aspect here, what I want to highlight is that I've made an acronym called HASIL. And what does HASIL stands for? H stands for housing, A stands for aspiration, S stands for security, I stands for investments, and L stands for long term. Now, when you are talking of HASIL, there is a I see a lot of social media accounts talking about SIPs at an early age. Just flip that argument into, instead of an SIP, the first H, which is of Hasil, stands for housing. So suppose you are a guy who has just taken up a job and have a 25, 30,000 salary, and if you have a house located outside the town and which EMI is about 5, 10,000 rupees a month, and the house might be 15 lakhs or 20 lakh rupees. If you start saving for that, it puts you into a disciplinary mode. So the hassle starts with housing, then it is for aspirations. For that aspirations comes the S, which is your SIP. But before doing that, what you have to look at is clearly, are you covered enough on mediclaim? Because that is something which you are going to need post your retirement. You can get loans for anything. You can get loans for studying, you can get loans for your car, you can get loans for your bike, iPhone, everything, but you cannot get a loan for retirement. And when you are going to look at retirement after the age of 60, for suppose the next 30 years, what is going to happen is your medical expenses and your expenses to pull you through are going to be huge. So when you are planning for your investments in personal finance, just see to it that your mediclaim is at a decent level. Even if you have got mediclaim from your company today, but I will suggest that you please take out a mediclaim policy. It might be a policy just for 1 lakh or 2 lakh rupees to start with, but you actually create a history with the insurance company, and you can always add on to your mediclaim as years go by. So, first, when you are trying to start investments, ensure that you have got a mediclaim in place. Also, at a younger age, if your salary permits, you can also go in for a decent life cover, and that life cover can be a 25 lakh or a 50 lakh pure term plan, wherein that actually saves from any eventualities. If there is any loan or any leverage what you have taken, it can save your family if anything has to happen. So before actually going into investments, the first tick box is identify savings. Put your savings ahead of your expenses. The moment you do that, you will have some money to invest every month. Then check your mediclaim. Apply for a mediclaim irrespective whether you have been covered by your company. The third is look at life insurance. And after that, you can actually start looking at the investments. So I'll stop here, and if we have any questions up till now, we can take that and then I can continue.
Yes, sir. So, I mean, as you pointed out while you were talking, that people voice is clear this time.
Yeah,
So, let's talk about debt management and how one can prevent oneself from getting into the debt trap, and likewise, what are I mean, no, normally there is a con- debate when it comes to which loans one should take and which loans to avoid, right?
yeah.
So, what's your view? Which loan and when one should take, otherwise to avoid, and how one can be like, as how one can escape the debt trap, basically.
So the most important thing here is that you should not take loans for depreciating assets. People argue that a car loan is good, The car loan is good unless and until you are going to probably use that car so much that the depreciation actually works in your favor. People have this habit of taking phones which are a lakh rupees, 2 lakh rupees on EMIs. The need and want and the necessity of that, if you take it from a personal loan from a banker, imagine that percentile of interest there is close to 13 to 14%. And what is more important is that you are paying that EMI after paying tax on your income. So you already pay 20 or 30% tax from your income, and after that you are going to pay 13-14%. So when you actually do this, you are actually falling into a debt trap. Second thing is, people have this notion that we call it compulsive dinners, wherein since somebody invited you over dinner or at a party, you feel that you should also invite people. I think that is something what we should avoid, because this becomes compulsive, and every other month we end up spending money which we actually don't want to do. If you are borrowing through your credit card, if you are doing a circling of your credit card, mind you, the interest rates there are anywhere between 36% to 45%. As I said, out of your 100 rupees income, suppose you are in the 20% tax bracket, you only have 80 rupees. And out of that, if you are going to spend 35 to 40 rupees as interest, you are sure shot getting into a debt trap. Third thing, what I have seen people do is that they borrow and invest. I think that is also very risky, because when people borrow and invest in, say, a stock market or an equity market, you actually are running a risk of losing capital, plus you have somebody who you owe money. So if the market crashes, and any black swan event can happen at any point of time, and if the market crashes and you have a liability, you actually have a double whammy. So what is more important is, first is identify your needs and wants. Second, do not go on a leverage which you can't actually pay. What they say is that credit cards, people generally play the minimum balance on the credit card and they keep on revolving the credit there. I have been into a bank as well. The most easy source of income for any bank, they like customers who pay minimum balance and they revolve credit, because they earn 40 to 50% on that outstanding balance. So that is something what you need to avoid. Second is impulsive purchases done through personal loans. I think that is something what you need to avoid. Third, as I said, when you are buying any asset, appreciating asset versus depreciating asset, you need to have a real hard look as to what am I buying and at what interest cost. People buy second houses, third houses, farmhouse plots. Just look at the utility of those before actually going and buying those, because you might be good by staying in a three-star or a four-star hotel, say for 4 days or 5 days every 6 months, instead of buying that farmhouse, because the maintenance and the upkeep itself will take you down. So, whatever decision you are taking in terms of spending your hard earned money, just have a look at it, what cost it is coming to you, and what is the appreciation that you are going to get.
Right, sir. So the behavior in the market is a very important aspect. So people, when it comes to SIP or maybe delaying the gratification, as we talked previously, they do not get the thrill. I've seen people investing in asset classes which are like what you say, not so proper in the sense they are not regulated, and on the top of that, like they think that they want to do something out of the box and become rich overnight. So how to control that urge and become a disciplined and sensible investor? Because having a reasonable expectation in the market, be it direct investing or passive investing, is very crucial in the market.
Correct. So, first thing is that you should not be competing against anyone. And I've quoted this example quite a bit of time that if me and you are going into a hotel and we both order a plain dosa, I am more worried that your dosa has come crispier than mine. And I think that puts the first wrong step for everyone, wherein people start comparing. Believe me, you, in the last 25 years, I have only heard people who have told me success stories of what money they made into stock markets. Nobody actually talks failure. And when people don't talk failure, we start believing that, okay, this is a very easy way of making money. But remember, you have to really think hard. A 14%, 15% kind of compounding is a very, very big number. And you have to just wait patiently there in order to get that return. People have been trying to get this from stock market in a day or two. You might be lucky, you might have a good streak wherein you actually earn for 1 week or 2 weeks or 1 month. And I mean, in a stockbroker, if you try to look at his earnings, he tells me today that he is earning only on the F&O trades what millennials are doing. Uh, when you say that, and I'm just giving you an example here, that when you look at Forbes richest list, every February you have the Forbes magazine which prints the world's richest people. They also print it country wise. My one observation in this is that, have you seen any singer, any sports person, anybody, any film producer, anybody there apart from people who hold equities? Like, you look at any of the richest list, no king, no monarchy, no guy who has got inheritance, nobody. The best pop singer, the best football player, the best cricketer, you have never seen those guys figuring in the richest list when Forbes publishes it. Why? Because over a period of time, over long periods of time, you will have only equity delivering better return. And all the rich people, either they are owner of their own companies, or there are some greats like Mr. Buffett who invest in other businesses and just hold on to those businesses. So over long periods of time, it is must that you should have equity, but do not have this adrenaline rush for comparing yourself for making money by comparing it to your colleague or your neighbor or somebody else. You have to be very mindful. It's your hard-earned money, and if it's a simple rule that what should we expect out of equity? It is nothing but GDP plus inflation. That should be your yearly return. So if GDP plus inflation over long periods of time is equal to 14, 15%, that is what you are going to get over long periods of time. So don't be under this impression, be it any advisor who comes to you. The first thing what we do at our end is expectation management. People come with 20, 25% expectation. I think our job is to tell them that have a reasonable expectation. If your debt is giving you 6, 7% today, if your GDP is at 5, 6% today, if your inflation is at 4, 5% today, then there is no chance that over long periods of time you are going to get more than 12, 13% return on equities.
Totally agree to that. So risk management, although we talked about earlier as well, so broadly, what all we should look for as far as risk management is concerned. So I'm asking in lines of asset classes, right? So how one should go about it?
Yeah, so what we generally do, and I'm giving you a very crude example. Uh, if we want to buy a TV or if we want to buy a fridge, what is that generally we do? We maybe talk to our friends, we go and look at 15, 20 models, we then compare the models, we then see what is the best price point, what is value for money, what is that we need, which this refrigerator or this TV is offering, and then we take a decision of buying that appliance. But if we look at equity, we seldom look at what the company is doing, who are their competitors, what has been their performance, how is the compliance and what is that the company is doing, and then we invest. We seldom give any respect to fundamentals, but we always try to go with momentum. When you're trying to invest in a company, you are actually going to become a owner of that company. But the whole focus has shifted as the cycles are getting shorter. The whole focus has actually shifted on uh, small bets, 1 day, 1 week, 1 month, and we try to say that we want to earn during that tenure. As you say that, just remember the last time you purchased any appliance, how much research you went through, or even today, when you go and book a hotel or a airline, you might spend hours in finding the best deal for you. In terms of investing, some study which you can do free of cost with so many sites and websites available. Just try to find out what are you investing and where are you investing, and some study there will actually help you so that you don't lose money. In terms of debt, this is in case of equity. In terms of debt, I have seen a lot of people currently going in for peer-to-peer lending. Instead of a plain vanilla fixed deposit or a bond or a debt fund, people have gone one step ahead in terms of risk and started looking at peer-to-peer. There are many ads, advertisements which come earn 10, 11, 12%. Please understand that there is a element of credit risk when you do peer-to-peer lending. There is a element you don't know the investor and pooling of funds in this. You are not actually sure to whom you are lending. While in case of a bank or in case of a debt mutual fund, you can actually have a look at the fact sheet and at least see what kind of companies you are lending to. So in case of equity, it is more important to do fundamental analysis, look at the company, its competition, its price point, and then decide. In case of debt, you'll have to look at credit risk, you'll have to look at liquidity risk, and you'll have to look at interest rate risk. When interest rates are moving up, avoid investing in debt. When interest rates are moving down, you can very well invest in debt on a longer duration where you can earn capital gain along with your accrual.
Right. So coming to reviewing a financial plan, so what could be the potentially a good strategy, and we can also, if able to touch upon with a view of time horizon, how regularly or after what interval shall we review our financial plans?
So your portfolio is actually like your soap. The more times you touch the portfolio, as the soap shrinks in size, so will your portfolio. That doesn't mean that you should not review your portfolio. And what I'm alluding to is avoid churn in the portfolio. If you have bought good companies, good stocks, good funds, review the portfolio, but do not churn the portfolio because for 1 quarter or 1 year, the stock or the fund is not performing. Typically, what I would suggest is that you should spend 1 hour every quarter in analyzing your own portfolio. If you have an advisor, you can sit with him. Otherwise, you should spend at least 1 hour every quarter in reviewing your portfolio. What you have to understand is that you should write down a framework, and the framework should actually guide you in terms of selection of asset class and selection of product. Unfortunately, what happens is you actually select a product and then start finding the narrative for that product. Don't try to look at your rear view mirror in the car and figure out where to invest. I'll give you an example. Last year, 2022, many of the investors, they actually looked at funds which delivered stupendous performance over the past 1 year, which was technology that time, and many of the investors invested into technology funds. And today we are seeing that funds are probably giving -10 to -20% return. So don't look at past performances and try and gauge the future. Predicting is very, very difficult. Staying diversified and in a diversified mutual fund or a diversified portfolio which you will make of your own will always be better. But every time you will have to review your portfolio, and that review has to happen at least for 1 hour in a quarter.
Right. So setting expectation, you talked about one. So what else like you, I mean, as far as client communication is concerned, so how it goes at your Sapient
At the
Wealth. So
organization,
how it gets? Yes, organization.
so most importantly, what is the role of an advisor? The role of an advisor is not to talk to the client when everything is going in the way of the client. Like if you are making stupendous returns, the advisor is not needed to give a call saying, "Sir, portfolio review करते हैं, अच्छा कर रहा है सब कुछ." That is not the time when you require an advisor. When you require an advisor, is your advisor has to be proactive in doing a change in your portfolio. An advisor has to be there when he is going to handhold you. Like for the past 14 to 18 months, you have seen that the market is flat. You are at 2-3% return on the benchmark. And at such jittery times, many a times I have seen investors stopping their SIPs or probably changing their funds. At this juncture, it is more important that the advisor talks to customers and he actually handholds them. If you can take out this flat return period, which generally typically stays for 18 months to 24 months or 36 months, you generally find yourself in a J curve wherein you can earn handsome returns. You plot any 3 year, 5 year rolling return, even of the benchmark. I'll give you a small matrix, and the matrix is GDP to market cap ratio. If you divide the GDP by the market cap, and if the answer in terms of percentile is closer to 100 or more than 100, then it means that over the next 3 years, you are not going to make handsome returns in equity. If you find that the GDP to market ratio is closer to 50 or 60 or 70, then probably over the next 3 years, you are going to make decent returns. What is GDP? GDP is nothing but the value of goods and services produced in your country. Effectively, it means sales. So if your sales is growing at 5-6% and your inflation is at 7-8%, which means your nominal sales growth, or as we know, nominal GDP growth, will be about 11-12%. This is the kind of expectation what a relationship manager or what a portfolio manager has to explain to the client, that if the market cap to the GDP ratio is closer to 50, 60, 70, 3 years are going to be better for you. But if it is close to 100 and above, then please expect that the returns from this asset class will be muted. That is what we try to do, wherein we try to proactively talk to customers and tell them what we expect, what is our view. And believe me, even if 60-70% of the time your view is correct, I think the client makes his return. After all, any advisor, any fund manager, any investor is bound to make mistakes. But if on the whole you can have 60-70% of your calls right, you are going to make your return.
I totally agree. And if the process is right and one gives time to compound things, then surely they will be well placed in comparison to most of the participants.
Sorry, I
So,
couldn't
Amit
hear
sir,
you.
like, am I audible now? Hello, am I audible, sir?
Hello?
Yeah, I'm speaking. Am I audible? Am I audible?
No, not really. You're breaking up.
Uh, what shall I do? I cannot drop, otherwise the space will drop. I am not sure. Am I less clear or I'm not audible at
Yeah,
all?
yeah, you're audible now.
Okay, thank you. So, Amit sir, I was
Yeah.
saying like initially the problem which individuals face is they have a very limited amount, right? And
Yes.
with that, they, I mean, doing SIPs or maybe investing in companies, that small quantity doesn't move any needle. So in such cases, what would be your
Right.
advice? Like when somebody is investing a very small portion, say from their savings or their salary, so how they should go about investing so as to make a humble base, and after that they can devise their process so as to like invest directly or whichever way it goes. I mean, what's your view around this?
See, the easiest way and the tax efficient way, if you ask me, is to start small, even with an amount of 500 or 1000 rupees a month. The best way is to go through a fund house. But mind you, don't go into a sector or don't go into aggressive funds. You can just stay into a diversified fund, and that should do the trick. More importantly, what is critical is that decide a percentile of your income that you want to save every month. Treat this SIP as your EMI. And when you'll treat this SIP as your EMI, it will actually make that retirement corpus or that goal what you want to achieve in the next 5, 10, 15 years. So amount does not really matter. It is the discipline that actually will take you ahead in terms of your wealth creation journey.
So, Amit sir, in your long experience of 23 years, what are few mistakes which you like to talk about so that we can also learn from your mistakes, and how had been your journey, learning journey?
So, uh, follow the trend. That's what people tell me. What I generally do is that I apply my own metrics as to if everybody is saying that we believe that this might be true. I try to talk to my colleagues or my mentors, wherein I use them as a soundboard. So please use your financial advisor or your friends or colleagues as soundboards and ask them that this is your thought and you feel that you should invest in XYZ and get your views. Do in-depth study of whatever you are investing into. Just don't put a roulette bet on any number what you think will probably make it on the table. You have to study because investment is something wherein if you don't really have an idea where your money is going, then probably you are going to have an unpleasant experience. Third thing, as I said, that do not take leverage and invest. Do not look at past returns and invest. Do not look at tax saving and invest. People make this mistake of investing because there is a tax saving element into it. You are investing and long term capital gain is paid on gains. So if you make money, then only you pay tax. Do not invest because you want to save tax. For everyone on the call, let me tell you very frankly that opening up a PPF account is very, very important. Giving a 7.2, 7.5% tax-free return, nobody offers you that. And at early age, you might start saving money at 7.125% tax-free. That also puts you into a disciplinary mode. Take your mediclaim and life insurance very seriously before commencing the journey in the world of investments. Just secure or safeguard the risk. Have a decent mediclaim, even if your company is providing you one. Have a decent life insurance term plan, pure term plan, no combination of ULIPs, nothing, no endowment, no money back policies, just pure term plan. I realized this very late in life that a personal accident policy is also of importance. So take the personal accident policy also seriously. Also look at when you're traveling abroad, have a policy for that and read through all the material there. Mostly I've seen that overseas mediclaim policies which are sold blindly and which are bought on the way to the airport, they actually do not cover any risk. There are some exclusions there. So you need to be very sure as to what you are buying. So be it investments, before investments, cover your risks. Do not invest in depreciating assets. Invest in assets which are giving you return. Like I said, a real estate gives you rent. a debt or a bond gives you interest, a equity gives you dividend. So it's your hard-earned money. Try to invest it sensibly and do not panic when there is a black swan event. Uh, this money is like a paper profit, it goes down. If you have a long-term vision and whatever you have bought are good companies or good funds, everybody will have a bad quarter or everybody will have a bad year. End of the day, and I'm saying this with absolute confidence, that if you pull out any 15-year data of any diversified equity mutual fund, all the funds typically are in the same range. It's unfortunate that the investor return and the investment return are very, very different. And what do I mean by investor return and investment return? Is what you see in the fact sheet for 15-year returns. There are hardly 1 or 2% investors who have stayed invested over that long period of time. Investor return is when you enter and when you exit. That is your return. But what you look at in the fact sheet is the portfolio return for those many years. So there is always a difference between investor return and investment return. Try to match your time horizon with that of the fund, and you will have a good outcome on this.
That's great pointer, and I must say it is very important for us to understand the difference between investment return and investor return. Very relevant. So let's say, although we talked about goals a bit, but again, say if I talk about broadly three goals which every family, like retirement, education of their children, and marriage of their children, so these goals are more or less have some 5-10 years of difference if on an average we take. So I mean, basis these goals, the strategy would be different for each one of them, or how it goes. Common strategy can also work, because if say the education is say 15 years away and the marriage is say 20-25 years away, so the same strategy goes, or it I mean, how exactly you guys do it at your
No, so any goal, what you actually have, the acronym there is SMART, and SMART stands for specific, M stands for measurable, A stands for achievable, R stands for relevant, and T stands for time bound. I'm going to repeat this. SMART goals means specific, measurable, achievable, relevant, and time bound. So it's a good way to plan the steps to meet the long-term goals in your grant. If you actually look at the goals what you mentioned, be it education or be it marriage or be it retirement, the longest is the retirement. And as I mentioned earlier, you can get loan for anything you want except retirement. So that is one goal which should be definitely in equity and definitely for 20-25 years. You should invest your money in equity for 20-25 years in order to have your peaceful retirement. For marriage and for housing, it depends on what time period you have in your hand. Typically, at the age of 25-30, we should start saving for your house as well as your children's education. Unfortunately, in India, till the time we don't approach 50-55 years of age, we do not take retirement planning seriously. And the same is the case with our children's education. Just imagine every birthday what your child gets as gifts from people in terms of money. Try to invest that in his or her name for long periods of time. Do a disciplined investing on their name for 10-15 years, and these goals actually don't look that big then. Many of the people also look at taking a student loan for their children. Uh, there is also one possibility that banks give you these loans uh, wherein the child, after finishing his education, can repay back that money. Just keep in mind two, three things when you take a student loan for your children. One is that what is the processing fee? Second is that what is the repayment charge? Third is that over what period of time, what is the currency risk that you are going to take if he is going abroad? And fourth is that is this too much for the child? So many people also think of paying off that loan every year through their savings today rather than going on loans. So retirement is the most important goal because medical science is going to make you live longer. Your children will probably put you in a ICU on a ventilator and you will still keep on breathing, but that expense is going to be crazy. Lifestyle diseases, blood pressure, diabetes, these are going to be a part of your life. So these medical expenses are important. So Mediclaim forms a very critical journey. You might have a term plan, but you might be stuck to your bed. So you don't die, so the life insurance does not come into play. At that time, it is only the Mediclaim which is going to save you. So please keep a tab on your retirement corpus. Do not dip in your retirement corpus for other goals. And minimum 5 years if you want to invest in equity. That is my take today.
Great, very important and relevant points you made. So, credit card, use of credit card, how wisely one should use a credit card or it should not be used? What's your view around this?
Typically, I use my credit card to earn points. I have that money in the bank account. I try to use the card, and as soon as I have that spend, I generally try to pay that outstanding amount on the credit card. But if you have a 50-day cycle of a credit card between your spend and the billing, just ensure that you pay the total outstanding amount and don't pay just the minimum amount. Because as I said, the rates there, rate of interest there is anywhere between 25% to 45%. So don't waste your hard-earned money, post-tax hard-earned money in paying off and doing this revolving credits. Needs what you have, you can definitely buy on your credit card. Wants can definitely be postponed and not bought on a credit card. I use the credit card more for collecting points. I have the money in the bank account, then only I spend, and I pay the outstanding due before generation of the bill also at times.
So you emphasize on paying off the high interest debt as quickly as possible. So when people take loan, what strategy they should uh, apply so as to do away with the loan as quickly as possible? Because the interest rate is, I mean, they end up paying more than the principal if the period is extended. So how one should go about it, sir?
I mean, simple is your housing loan at 8% over a 20-year period. You are any which case paying 300 rupees for a 100 rupee loan. Do you think that the house is going to appreciate twice? And this is, again, I'm saying this is post-tax money what you pay for the housing. There is only a 2 lakh rupee uh, income tax benefit what you get. Earlier, you used to get a second house, loss on house property. All of that now is not available. So whenever you are taking any loans, just try to ensure that you scout for the best deal in the market. Read the fine print. Many a times, processing charges, prepayment charges, and the prepayment penalty is something where you get stuck. So have a look at that as well. Try to scout for the best deal. Look at what kind of collaterals are being called for the loans that you take, and typically avoid your house where you stay as collateral if you're borrowing for your business. If there is a dire emergency, I can understand you can do that, but people go in for gold loans, people go in for all sort of things for luxuries or aspirations. Try to avoid that, keep it to the minimum, and just try to pay off your high cost debt, replace your high cost debt with a low cost debt, and that is how you can actually make a wealthy journey ahead.
That's great. So, for our attendees, just in case you have any questions around today's topic, please feel free to send in a speaker request. I will approve, and you can take your question too, Amit sir. So, Amit sir, like broadly, we covered and took most of the questions, but still, again, something in your mind which I didn't ask so far, and you wanted to tell our attendees anything.
So, most important is that uh, don't try to compare yourself with others in terms of your returns or in terms of status or in terms of anything. I think New York is 10 and a half hours behind India. That doesn't make New York slow. San Francisco probably is 12 hours behind India. That doesn't make San Francisco slow. So everybody has got his own path and is on his own journey. He will reach his destination in his own time zone. We don't have to compare ourselves with anyone. I will just probably say some do's and don'ts in terms of personal finance, and then probably we can take questions. First is create a budget and stick to it. At least try to save 10% of your income for emergencies. Invest in retirement as soon as possible. Most important line is live within your means. Pay off high interest debt as quickly as possible. Use credit cards very responsibly and pay off balances in full every month. Please educate yourself about personal finance and investing. If anybody, any of your advisor is trying to sell you a product or tell you to put money in a particular product, just ask the advisor that has he put his own money and ask him to show you his account statement. Have a financial plan, and as you were saying, we should review it regularly. Negotiate for better rates on loans, on credit cards, on insurance. Don't stop only on earning money, but try to generate money from your investments. That is nothing but building multiple streams of income. On the don't side, I think don't spend more than you earn. Don't take debt you can't afford to repay. Don't invest in anything you don't understand. Most importantly, don't make impulsive purchases. Don't neglect your credit score because when you will require a loan, this credit score might hamper it. Don't ignore your retirement savings. Don't put all your money, say, in one investment. Don't let the fear or greed actually drive your investment decision. And most important, don't forget to regularly review and update your financial plan.
Right, sir. So one question is around like when it comes to insurance, what all one should look for before selecting a suitable insurance, be it like a life insurance or maybe a mediclaim, if we can say.
So, in case of Mediclaim, just look at the exclusions. If there are any exclusions in the policy, your pre-existing diseases, if I'm correct, most of the Mediclaims they have a 4 year cool-off period. Post 4 years, all the pre-existing diseases are also covered. Have a look at that. Try to disclose everything, uh, every ailment what you have in the Mediclaim form when you are submitting it, because otherwise the companies might reject your claim based on unfurnished data at the time of application. So have a look at all of that. In case of a term plan, I think it is become very straightforward. Look at a pure term, low cost term plan, and that is available even direct on all the websites of insurance companies. Try to buy uh, a plan of a company. When you're buying life insurance, please remember this, that the life insurance company should survive you. So just don't go for a cheaper plan, but you have to take a plan from a company which you think will have larger life than you. And therefore, go with companies who you think are financially stable, their ratios are good, they are well capitalized, and they have more capital in case of exigencies. So that is what I would like to say on Mediclaim and insurance.
Right. So, Amit sir, broadly, if I ask about like the current market situation, although you believe in long term and over a long term, always market is upwards. But again, the broad happenings or the current landscape in the market? Any views around that?
So, I think what we have to look at is how is the money flow or liquidity moving? And this determines a lot in case of any market, be it debt, be it commodities, be it precious metals, or be it equity. 2 years ago, 3 years ago, during COVID, when the pandemic had hit, you had all the central banks printing currency and you were actually floating into liquidity. And when you have so much liquidity, it gets into any asset class and the asset classes actually bulge. Now, there are two things what happens because of so much liquidity. One is it brings in inflation, and after it brings in inflation, there is no choice but the central banks have to raise interest rates in order to kill demand. Now, when you are trying to increase the interest rates, one simple rule, the cost of money is going up. Second, what you need to look at is the availability of money. So, one is cost of money, second is availability of money. If cost of money is going up and availability of money is going down, then definitely you are entering into a recession phase. You look at 6, 7 years of two-wheeler growth in the country. In spite of it becoming a necessity that everyone needs a two-wheeler since our uh, public transport system is not that efficient in cities and towns, still you have not seen growth in the two-wheeler segment. Reasons can be there was a rural market which was not doing well, interest rates were high now, and all of that. But try to pick up such kind of tidbits from the market. If the cost of money is high and the availability of money is going down, then you don't expect growth in the market. And if you don't expect growth in the market, it means you don't expect growth in EPS. And if you don't expect growth in EPS, you will not see equity markets going anywhere. If you see inflation, in order to contain inflation, the only alternative is to increase rates. And this time around, when rates go up, they are not going to come down in a hurry. So as we were used to lower for longer rates, now we'll be used to higher for longer rates in India and across the globe. Because the moment you start interest rates coming down, again the demand will go up and that will again translate into inflation. As far as India is concerned, anybody who is on the call, any phone we are using, any wearable we are using, any shoes we are using, any car we are using, everything, almost 60, 70, 80% of that is imported. So whenever demand in this country goes up, what we intend indirectly is that we import more. And when we import more, it puts stress on our current account and then our fiscal. If both these deficits go up, what you import actually is inflation because your currency goes down. So, according to me, this is a time where you have to be very much cautious, protect your capital, and you have to have a muted expectation on returns. Just stay your course on asset allocation and accordingly, according to the market, according to the interest rates, according to the currency movements, according to the commodity prices, keep moving your asset allocation in the right asset class.
Right. So, sir, financial freedom is a catchy and buzzword of the town. So, do you believe like the concept of financial freedom is important so as to set our goals, or it's just one way of achieving the things? Like, what's your view around this?
So, uh, I think a huge mistake that many of us make is to work hard our entire life for money and not require money to work for us in return. I think that is something what I believe in terms of financial freedom. Financial freedom, if you really try to uh, uh, decipher, it's more about less about financials and more about freedom. So, if your wants are less, I'll give you a mythological answer to this. A very successful businessman went to a spiritual guru and he said, I want peace. And the spiritual guru in return said to him, remove the I and remove the want. What remains is only peace. So, the best thing money can buy is financial freedom. So, how much you want to spend on what? If you want to spend for keeping it in front of people, then there is a problem. Too many people, as they say, spend money they earn to buy things they don't want, to impress people that they don't like. And therefore, I said that analyze your needs, make a distinction between needs and wants. Don't compare yourself with anyone. But risk comes from not knowing what you are doing. That's what Mr. Buffett says. And therefore, financial freedom means that I can spend uh, carefully. I can take a loan, but I have the ability to repay. I am not against taking a loan or taking any leverage. It's just that we have to be very careful about where that money is going and where is that I am earning my money. So, life without liberty is like a body without spirit, and that is financial freedom to me.
So true, sir. So, any good literature or books which you will suggest our attendees on today's topic, or maybe related to financial markets, which can be really helpful in their journeys?
I think even if Psychology of Money can be read, I think that is one book which gives you a perspective. The very old famous book of Rich Dad Poor Dad also gives you a very good perspective on this. And any Daniel Kahneman book on behavioral finance. Uh, I think what people need to really understand is that they follow successes. But before Eagles became a successful band, there were 500 others which actually shut down. So you see only a few EV bikes successful on the road. But before a successful EV bike, you might have seen 500 startups in EV which went bad. So try to analyze this and try to read about human behavior and behavioral investing. That should help. But to start with, the psychology of money as a text, uh, Rich Dad Poor Dad, and of course Mr. Graham's book. Those are good enough to make your journey into investments.
Great. So, any advice to people who are looking for making a career in capital or maybe financial market?
Uh, this is a career which can actually change people's lives, and I'm saying people as in clients. If you are true to yourself and if you genuinely believe in good advice for your clients, if you do what is good for your clients, end of the day it becomes good for you. Whether it is advisory service, consultancy service, distribution service, anything. But if you make the right decisions for your clients with integrity and trust, believe me, this is a field which can take you places. Remember, you just have to pass couple of exams in order to come into this field. Uh, Suppose I am a builder, I have to go through so many things at the corporation level, at the corporator level, at maybe at the goon level, and all of that. But in this field, you don't have any restriction. You don't have any compulsion. You just think about your client, and if you deliver advice, what advice you give to your mother and father and your parents, your immediate family, if the same advice you can give to your clients, I think sky is the limit in this sector. You can reach places in financial services sector. Remember, not only on the asset side, but even on the liability side, you always require finance. So if you're in the financial services sector, you have to just be empathetic towards your clients. And those two words, integrity and trust, if you follow that, you are going to reach a pinnacle in your career.
That's a great advice, I must say. So, Amit sir, before we close, if you want to tell more about Sapient Wealth, that would be appreciated. Yeah.
So, this company is a 14-year-old company, and it's about 24, 25 years what I have been into financial services industry. My colleagues' combined experience is about 100, years. We have all employees who have been there with the company since day one. Uh, this is a company which is a financial services company, and we don't claim to be the best return providers to the clients. But what we believe is that we are solution generators for people who have problems in their investment journey. We are not here to predict the market. We are not here to say that your investment will give this kind of return. But if you just tick the boxes and stay on a path, I think our job is to make sure that you reach your investment journey in a time bound fashion. So, integrity, trust, client's interest first. That is what I will sum Sapient as.
That's cool, and I must say keep on adding value, and surely wish you a tons of success in many more years down the line. So thank you for taking time out for this session, sir. It was really helpful, and you, with great humility, you answered all the questions, and surely a value addition for me as well as our regular attendees. And the session is recorded, and I'll be uploading this session over YouTube. So those who join late or maybe want to listen to this important topic, they can also tell their family members to listen to such podcasts because it is relevant to each and every individual in everybody's life. So yeah, and obviously the more we are educated on personal finance, the better we are ought to do. So any closing remarks, Amit sir, before we close?
No, I think everybody, as I said, everybody is in his time zone. Uh, Getting ahead of somebody or falling behind somebody should not move you from your financial goal. Just keep on doing. You have to be on the pitch, and there will be a loose ball which will come, and you will be able to hit a six. It's just that stay on the wicket, guard your wicket very well, and the moment you get a loose ball, take that risk, and you will be able to get that return. As I said, first is mediclaim, then is life, term insurance, and then you start your investment journey. Do not outgrow your earnings by spending much. We are a savings economy, we are not a spending economy. If you want to spend, definitely try to learn what is income first and then what is expense. And the golden rule is income minus savings is equal to expenses, not income minus expenses is equal to savings. That's about it.
Great, sir. Best advice to close today's session. So thank you once again. So and thanks everyone for joining and listening patiently to this wonderful session. We'll come again with many more such sessions. So for the wonderful insight shared by Amit sir, you can connect with his handle, and obviously you will get a touch and feel of so much of great information shared over his handle and at his venture. Thank you everyone. Good night. Take care.
Thank you.